Hello and welcome to Livewire's annual Alternatives in Focus series. I'm Sarah Allen and today I'm joined by Darryl Clark. Darryl is the Deputy Head of Research and Manager Alternatives for Lonsec. And today we're going to be discussing the state of alternatives and how Lonsec are evaluating strategies in this space. Thank you for joining us, Darryl.
Thanks for having me, Sarah.
So to begin with, how big is the alternative space and how quickly is it growing?
Well, Sarah, it's actually been growing really fast. So if I think about the last 2 years, at Lonsec, we've seen our coverage of funds in the alternatives universe grow by about 50%. And it seems to be growing by the week, actually. So we're quite in a fortunate position where fund managers keep on bringing us new funds to review. And I guess if you think about what's driving that, we all know it's been an uncertain environment the last couple of years. People have been looking at equities and bonds and the behaviour of those two asset classes and how they blend together in a portfolio. And people are really looking at alternatives as a differentiated source of risk and return that they want to bring to their portfolios.
Okay, and what are some of the key trends that you're seeing emerge across the space?
I would say without a doubt, the biggest trend is the rise in private market offerings. So I would start by saying that if you go back 2 years ago, private markets were a much smaller part of our funds under coverage. It would probably been about 15 to 20% of the funds we covered. And the largest would have been something like global macro hedge funds and trend managers. And they would have been about 40%. Now in the last 2 years, that's really switched around. So private market offerings are now about 40% of the funds we cover. And like I say, it's growing by the week, it seems at the moment. And I guess if you think about what's really driving that, there's this structural change in the markets where public markets are shrinking, private opportunities have grown significantly through time. And for retail investors, they're now able to gain access to these type of opportunities through what people are calling a more sort of democratised access to private markets. So through a managed investment scheme that has either monthly or quarterly liquidity, normally with a cap around that. And that's a big change in the past if you think that they've been the mainstay of institutional investors for the last 10 to 20 years. And institutional investors have been able to write cheques for several $1 million to private equity firms. Now retail or wholesale investors can gain access to the same opportunities. So that's probably been the biggest step change that we've seen in our coverage over the past 1 to 2 years.
Okay, and part of the big appeal of alternatives is obviously different performance compared to, say, equities and fixed interest. But what are you seeing in terms of performance across the strategies that you evaluate?
Yeah, it's a fairly difficult one to answer in some respects. So I think the one thing I'll try and get across to viewers is alternatives, it's a very broad church. So don't necessarily think about it in terms of an asset class, but rather a range of strategies. And the level of dispersion can actually be quite significant when you're talking about performance. So all of that said, and I should say, the funds in the universe have very different risk and return characteristics. So all of that being said, if we look back at just a shorter term time period, like 1 year, stronger performers would have had returns of around mid double digits, and that probably would be some of the private markets or private equity funds that we've spoken about. And at the lower end, it's probably been around sort of negative double digits, to be honest. So you can see there's quite a variety there, and you'd probably see something quite similar even if you were to look over a 3-year period. So I think if we try and break it down a little bit and draw out some observations, if we start on the more sort of liquid side of the alternatives universe, so something like a trend manager, for example, go back 12 months, and they had some really strong 12-month returns. So trend managers, they were benefiting from strong trends in markets. I mean, that they do what they say they do, essentially. They're trying to capture momentum from various markets. Think about last year, strong trends in US dollar, fixed income, commodities, and they all did really, really well. Now, some of those liquid managers like Trend had more muted returns this year, but you can probably break down that universe a little bit into trend managers that purely capture trends versus those that also have some complementary strategies attached to it. So Trend managers that have things like non-trend signals like carry, value, some use seasonality. Some of those strategies have actually performed really strongly this year. So while returns have been more muted versus last year, they've been okay. And then if we turn to the more illiquid universe, private markets, which we've spoken about as a strong trend, look, they've still been fairly resilient, so performing really well. And look, people ask about performance in private markets all the time because of unlisted asset valuations and the like. But when we speak to our managers, they tell us that on a look-through basis, companies that they're investing into, earnings have still been fairly resilient, valuations are still okay, and the companies are actually, while facing maybe some headwinds, are still doing fairly okay in the market that we've got. So that, and even if you were to look at, say, the private debt universe, similar type of scenario where companies have been fairly resilient, and we haven't really seen that default cycle pick up as much as some people expect. So performance from those private markets offerings have been fairly good as well.
Okay, and where do you think are going to be the opportunities going forward? Which types of strategies are going to perform better in the coming months?
It's an interesting one because I've kind of been waiting for this period for quite some time, to be honest. You know, I've been looking at alternatives for 10 to 12 years, and much of that post-GFC period has been tough, right? We've had central banks intervening in markets, it's crushed the volatility, and that's been a really kind of weaker environment for hedge funds in general to perform. But we're now moving into this environment where, like I say, regime change, rates are rising, volatility is coming back. Now that type of environment creates a bit more dispersion in markets, and that creates a lot more opportunities for managers. So whether it be long-short managers, or it could be managers who play relative value in the markets, where they're playing the spread between two different securities or two different markets, that type of volatility is really, really important. Likewise, if we look at the private market offerings, there's an environment in which they can still do pretty well, although I think times for them may be a little bit more challenging. That doesn't mean you shouldn't allocate to private markets, but they could be a bit more challenged because rates are obviously higher, and it's harder in that environment for private markets, private equity managers to generate a return, and they have to sort of lean on other levers, just the traditional sort of value creation levers that they have.
Now, obviously, these strategies are quite complicated to build and run, so they come at a cost. What should investors be expecting to pay to use these strategies?
Yeah, look, I guess you're right. They are a bit more complex and they are a bit more sophisticated. So you can expect to pay more than what you would for a traditional active equity or bond manager. And look, so maybe taking a step back, the way that we tend to look at fees is we sort of score managers on the kind of the quantum of fees. So, you know, what's the overall level of fees, but we'll also try and take into account the fairness of that. So, you know, is this fee easily replicated by cheaper offerings, for example? And are you paying a fair fee for the actual alpha that the manager can potentially generate? So all of that said, depending on the offering, and again, it's a broad church, people can pay anywhere between 1% for some of the less sophisticated offerings, probably anywhere up to about 4%. So 4% would be is probably near the upper end, and that would be for some of the private markets offerings. But then those managers are occasionally generating returns of 15 to 20% as well, net of the fees. So people should always expect, if they're sort of paying a higher fee, you want them to be getting a decent return in regards to that.
Okay, and how do you determine which strategies receive Lonsec's highest ratings?
What viewers should expect is that we're using the same Lonsec research methodology and approach that we do for traditional asset classes. So you can expect that we're looking at the business, you know, how sustainable it is, how strong is the business. We'd be looking at the quality and the capability of the investment team. We obviously spend a lot of time looking at the investment process and the repeatability of that process. But there's probably a couple of areas I would draw out for alternatives, because I guess if you think about areas in which some hedge funds can go wrong, for example, it's sometimes around risk management. So we spend a lot of time looking at how funds manage their risk, what systems and what infrastructure they've got around managing that, what kind of look-through they have to the underlying exposures within the portfolio, levels of diversification. And we also want alternatives to really do what they say on the tin. So if investors or our subscribers are going into alternatives expecting that this is going to offer a low correlation to equities, then of course we're going to look at correlations. We're also going to look at the beta to equities and just try and make sure it's delivering on expectations. The other area that we tend to focus on quite a bit actually, maybe more so for private markets offerings, is just governance around some of the operational aspects. So we mentioned valuations earlier and things like that. So we'll spend a lot of time thinking about the process managers have in place to ensure fair valuations are put on things, because when you've got an offering here which is essentially a liquid but in a semi-liquid offering, you want to ensure people can transact in and out of the fund at a fair price. So I guess what do I mean by governance around it? I guess we want to ensure there's as best as possible third-party valuations involved. We want to ensure that those are audited. So the more independence around that valuations process, the better. So those are probably the two areas I would draw out, sort of the risk management and the sort of the operational, the governance side as well.
Thank you for sharing your insights today with us, Darryl.
No trouble at all, Sarah. Lovely being here. Thank you.
And if you enjoyed that interview, please subscribe to Livewire Markets and Market Index. Thank you for watching.